All right, so once again, everybody welcome, starting from introduction. All right, let's just go through to see what actually um, Excel solution is made of. Excel solution, I know almost everybody here have his own Excel solution. So if you have it, you can log in. If you don't have it, yeah, if you can log in, if you're logging in with your phone, you can just stay with your phone. And more especially, I would advise for everybody to have piece of paper that you can write something down. We know that sometimes our brain is so smart, but if you put yourself in that situation that, look, I'm trying to study now. In as much as I say here, nobody's teaching anybody. We are just discussing. I'm just moderating. So nobody's teaching anybody here. All of us can write this exam without even anybody listening to anyone. You can read it and write by yourself. That's true. So I'm just moderating. However, to make it easier for everybody, since we are starting from beginning, I would suggest that if you have a piece of paper or a small note, you have keep it by your side and a pen so that there's some things you can jot down. That will remind you of those things instead of just listening. If you're just listening, honestly, it's not going to be fine. You're going to forget some things. Nobody's a computer here. So even me, I have my own notes. I have my own pen on my hand. I write and say, so some things I see, if I know that they are important, I write them down. That would be a reflection. That would be a sort of guide. That would be a sort of trying to remind me of what I know. You understand? So my advice would be get a jotter, get a pen, write things down. Don't just stay and listen. If you stay and listen, you'll not be enjoying the discussion, honestly. But if you see some facts, you write it down. Those facts, a day to your exam, you can just go through them. That will remind you almost everything you have had. That's my suggestion for everybody. So we're gonna go to course introduction. According to Excel have been there. We have two exam first, we have Excel, but believe you me, I so much love Excel solution. So I encourage everybody to have Excel solution. It's quite, they are good. They are good. I tell you the truth, they are good. Excel solution are so good. I like the way they tablet and more especially their video. Their video is what is helping. Some people can just open the Excel solution and listen to the video. And some of them listen to the video with a good mind and no distraction, and they go to exam and pass. Yeah. So let's look at what Excel solution suggests us. Of course, this is a study material. It's not a book, it's a study material created by Excel solution. They have power, they have protected power over it. We are using it to study. We bought it from them. We are using it to study, and almost everybody here have it. So just like say, all rights are expressly reserved to them. They have the right, they have everything, they have the material. We are just listening and reading from them in a group. We are just reading in a group, discussing so that to help us to go and pass the exam. So this is what Excel solutions suggested for you. Best in class pass rate. Of course, best in class pass rate is just exactly what we're trying to replicate here, because all of us are in the same zone discussing the same material. So Excel solution equally made it a way that you can do it by yourself. You see this person here, he is using on himself. He has his laptop on his front. He has a pen. He has his phone. He has some book and pen, writing some things down. This is exactly how everybody's supposed to sit. Believe you me, as this person sits, this is exactly how myself sat. I sat in the table and I have my pen, I have my book. That's how it's supposed to be. That is study. So for somebody to just be listening without being in that study mood, it doesn't work that way. Remember, most of us have not sit on a chair for the past 20 years to read. That is the truth. Because we are preoccupied with some other things in our life. Now we decided that, look, we want to enter into financial understanding by going through writing life insurance and being into finance. That is the more reason why we should do that. Based on our several years of not opening book, some people have not opened book for the past 20 years. It's the truth. And nobody's blaming anyone because you have some other things to do. You have taxed yourself to get this license, which means you must, at least for this period, comfort yourself to a position that be in a study mode to study. Give you any time you want to study, 1 hour, 2 hours, just be in a study mode. Get it done, pass the exam and go. It's not a good news about this exam. You pass, if you are writing from Texas or any other state in America, the 50 states and Hawaii, you wrote and passed that exam, you are not writing that exam again. And you are privileged to do business within any state of your choice. So let's assume you are in Texas, you write the exam and get Texas license. That Texas license you have, you're not going to, if you want to do a business in Georgia, you're not going to write Georgia exam. You're going to just apply for Georgia license. They will give it to you for the fact you have passed in Texas. So which means this is the first and the only exam you're going to do in life insurance. Every other thing you're going to do to get license in another state is just to apply for the license. So you're going to write it and get it once and for all. And guess what? Nobody want you to score 100. Your target is just to get 70 over 100. 70 is the pass mark. If you get 70, you are passed. You passed. If nobody say get 75. If you get 75, you can dash them 5 marks. Use this. What you need is just 70 to have congratulations in your paper. So that makes it so easy for us because they know those who come to this industry are most especially those who have either retired or young people maybe who have left school for some time. They made it as they look as if it's a continuing education. You cannot compare this with when you're writing NCLEX exam to be a nurse. No. Or however, those who set the web where you are writing those who conduct the nursing exam, also the people who are conducting this one. Pearson VUE. There are people who are conducting this one. In some other states, it's still some other people doing it, but we know within most of the states is Pearson VUE. Pearson VUE, they are the people that conduct nursing exam. There are people that conduct medical exam. They are the Pearson VUE. Even to be a real estate, they are the people that conduct it. So that to show you the authenticity of what we are doing. It's not just something you wake up to start doing. You must be licensed, verified, and stamped, approved to do the business. Yes. All right. So this is how it's supposed to be. The study mode is supposed to be. Of course, if you have laptop, all these things, any of these following browsers can work for you. Chrome can work for you. Firefox, Edge, and Safari, all of them are good browsers. They can work for you. So getting started, 3-part training. You can have a 3-part training, the pre-licensing one, the exam one, pre-review, and what? Stimulated exam. So like if the person who's writing on Saturday told us that she wouldn't do it by herself, we have gone to this exam because we have finished the pre-licensing. We have gone to exam 1, finish exam 1, go to pre-review, then do simulated exam. So that's all the exams in the preparatory class. Most times, if you complete the exam, if you complete the pre-licensing course, they will issue you certificates. Most states, they need the certificate. They need you to show them the certificate you have completed before it can allow you to write the exam. That's how it is in most states. Of course, completing the comprehension final certification exam. That is for some states. If you finish reading, they want you to complete the comprehensive final certification exam. If you are from those states that need it, definitely you're going to see it down there where they told you to do it. Comprehensive final exam. They will want you to do it before you be qualified to go and write the exam. Yes. So when you do this exam, you now give them, print the certificate and show them. So that's what it is. And again, they require you to get only 70% on the comprehensive final exam. You're expected to get 70%. So 70% is the pass mark. Look. So that's the introduction. So let's go to basic principles of health insurance. Chapter 1, the basic principles of life and health insurance. You know, at the beginning, we're talking about principles of life and health insurance, but later on, you're going to see that we are treating life insurance, then after we do health insurance. So the exam, some people can opt to do life insurance, life only. Some people can do life and health. Some states, they may allow you to do life only. Even I think it takes that you can do life only. Then after you come back to do health. But however, if you decide to do life only in Texas, when you come back to do health, you're still going to read the same material. So you're going to still read the same material to go and do health again. So why not do life and health at once and get it done than to do life, you read the same material, you pass life, you now come back, want to do health, you read equally the same material to go and write health again. So that is, you are doing what? I said the person is really punishing himself. So why not do life and health at the same time? So most states is not like that. Most states you can do life after you come and do health. So they give you section that you do health and section that you do life. That one is easy to do life separately and health separately. However, in such states, you can decide to do life and health at the same time. So let's look at this. Before now, life insurance is a thing something that you need now because you don't need it now. But tomorrow you will need it. And that time you will need it, you may not have it, may not get it. Now that you need it, it seems that you don't need it. But at the time you need it, you may not get it. That's exactly what it is. Unlike your auto insurance, at any time you wake up, you do it. No. This one, there'll be a situation you can no longer qualify, you will not be able to qualify to get it. So the opportunity of today, the opportunity of now is the opportunity for you to get the policy. Tomorrow, the opportunity of today may not exist. Tomorrow, the health concern of today may not exist. Tomorrow, there may be health concern that does not exist today. So the opportunity of you getting life insurance is today. Tomorrow, the opportunity of getting it may not be there again. So try and get what you can get. It's not mean that you must get more. Get even as little as you can afford. But instead of you not getting at all, get as little as you can. It's a very good advice, which I think if you do it, you will not going to regret. So imagine waking up into a store to buy a new smartphone. All of us here have a phone. Nobody who's here who doesn't have a phone. You know exactly what you are getting, of course. You want to go and get a phone, you want to go and buy television at Walmart or anywhere, you know exactly what you're getting. Your mind is telling you that, look, I'm going to buy phone. Your mind is telling you, look, I'm going to buy television. You know exactly what you're getting. The device, the specification, the features, even the set price. You may know the price before you go because you must have done market research. But in life insurance, you don't know what you are getting. You don't know. You buy insurance, you are purchasing a promise. So when you buy life insurance, you do not know what you're getting. You are only purchasing what we call a promise. What is that promise? A promise of financial protection against future uncertainties. All right, let me get it again. You go to the store, you know what you're going to the store to get. Your family demand is to go and buy television. The children want to watch television and you want to watch television. Before you go to a store to buy that television, you already know what you are going to buy, television. You know the price, You know the product, the specific product you want. Of course, if care is not taken, you don't even have to, you don't have to operate it. You have not bought it, but you know what you're getting. But that is quite different in life insurance. It's quite different in insurance. In insurance, you do not know what you are buying. You are only buying a promise. You are purchasing a promise. And what is that promise you are purchasing? The promise you don't know. You are purchasing a promise of what? Financial protection against future uncertainties. Future uncertainties may be sickness. Future uncertainties may be death. Future uncertainties may be a demand to have, maybe financial pressure where you need some money. Future uncertainty may be to make sure that your children go to school without student loan. Yeah, future uncertainty may be to save money for that small child that is 2 years today, to buy a home by himself by the time he gets up to 30, 35 years or 40 years without going to borrow money from the lenders. Yes, all those are future uncertainties. So you buying the promise, you are buying the future of uncertainties. So you decide to buy the future, but that future have a special promise of what? Financial protection against the uncertainty you are going to see tomorrow. The uncertainty may be death, uncertainty may be any disease, God forbidding diseases. So there are uncertainties. So the unique aspect of insurance is why understanding its basic principle is so important for anyone entering the field. So now that you are preparing to enter the field of insurance, believe me, what we are doing here is not only about for you to go and pass the exam. Far be it. Now, we are not only doing for you to pass the exam, we are trying to get you into focus, the thing you needed, more especially for you to be able to buy that promise. That promise can guarantee you financial protection against any future uncertainties. That's what we are doing here. We are trying to tell you the right thing to do, how to invest, and how to do the right thing for tomorrow, more especially for your retirements. So you have the opportunity here not only to write policy, life insurance policy, but however also to write annuity and some other things that you can do with this license. So many things you can do with the license. I tell you, so many. But the greatest of it all is that you now become financially aware of your surrounding. You now want to control the $10 you make in your work. You now begin to think of your retirement, because a rightful thinking of retirement starts from the very first day you start working. That's how it is. But unfortunately, most of us is not. Most of us have started not only late. Most of us are at the back. So for the young ones who are just starting their career today, you get starting their first job, your retirement should start immediately. You get to start your first job. That's when you're supposed to start planning for retirement. For you to get a wonderful time-relevant retirement. Time-relevant retirement. Yeah, you have to start today to prepare it. Otherwise, you'll be like others. So that's what you go to the store to buy. That's what life insurance is by. So in the chapter 1, we are going to do what? Find out the fundamental concept that formed the foundation of insurance industry. The fundamental concept that formed the foundation of insurance industry. Whether we are considering what career as an insurance agent or preparing for your licensing exam or what, and this concept will help you understand how insurance works, who provides it, and how it is regulated. So this is what we're going to see in this chapter. How insurance works, who provides insurance, and who regulates insurance. This is exactly what we're going to see in chapter 1. How insurance works, who provides it, and how it is regulated. That is what we see in chapter 1. So basically, we're going to see definition of insurance. What is insurance? So we start with the basic principle of how insurance transfer risk from individual to insurance company through premium pooling. If somebody asks you what is the definition of insurance, is just a transfer of risk. Insurance is just a transfer of risk. So that's what that single definition of insurance. It is a transfer of what? Risk. You are transferring risk from your risk to the insurance company. Insurance company turn around and say, look, this risk you're transferring to me, I will take it all, but you're going to pay me some token. And what's that token? The premium you are paying. So you transfer the risk, and the risk, the insurance company collect the risk from you and tell you to pay premium so that they can hold the risk for you. You know, it's not easy to hold risk for somebody. If it's possible, all of us will transfer everything we call risk in our life and give it to insurance company so that we can pay them. If it's possible. Imagine when you transfer the risk you have to somebody to hold for you. You'll be living, a life you'll be living will be a life of miracle. You're living by yourself, no problem. You don't have anything. You wake up, eat, go to gym and gym up, come back to take a shower. Because the sickness you have transferred it. The poverty, you have transferred poverty. Everything around you, you have transferred to insurance company. It's possible. Most people would have done that, particularly those who are rich. So we start with a basic principle of how insurance transfer is from individual. Because how it works, how it's affecting us, that's what we're going to see. So then we will examine different types of insurance. In this chapter, we're going to see different types of insurance and how they are structured. We're going to see different types of insurance and how they are structured. We will also learn about key departments within what? The insurance companies and the roles of professionals such as agents, underwriters, and actuaries. We are also going to look at how insurance is sold and the evolution of industry oversight to protect consumers. The evolution of industry oversight to protect the consumers are the provisions. Remember, when we talk about the provisions, we say we have 23 provisions. We have what? 23 provisions. We have the 12 mandatory provisions and the 11 optional provisions. We say the 12 mandatory provisions benefit the insured, and the 11 optional provision benefit the insurance company. That's what we said in the morning. All right. So in this chapter, roadmap to understanding the insurance industry structure and operation, while some concepts may seem complex at first, we will break them down into clear, manageable prices that will prepare you for both your licensing exam and your future career in insurance. Believe me, this is one of the things that can happen to them. To know this, to know everything about what we are doing, is one of the things that you cannot forget. So let's listen to the introduction. It may be there's no difference between what I just said, but what he's going to say. But let's listen to him. It's about 11:54, 11 minutes. 1 minute 54 second video.
Welcome to the Basic Principles of Life and Health Insurance chapter. I'm your instructor, Donna, and I'm thrilled to help you kick off your journey toward becoming a licensed insurance professional. You've taken a big step. Congratulations. In this chapter, we'll explore the foundational principles that make the insurance industry work. By the end, you'll be able to complete the following: explain key insurance concepts such as risk transfer, indemnification, and premium pooling, distinguish between major types of insurance companies, identify key departments and roles within an insurance company, compare different insurance distribution systems, explain the evolution of insurance industry oversight, and finally, describe the roles of major industry organizations like the NAIC. Let's start with a simple idea. Insurance isn't just a product, it's a promise. Unlike buying a phone or a car, when you buy insurance, you're buying peace of mind. First, you'll learn how insurance companies take on risk from individuals and spread it across large groups. This is what makes financial protection possible. We'll also look inside the insurance company to understand who does what, from producers and underwriters to actuaries and adjusters. These professionals work together to make sure insurance works for everyone. Finally, we'll explore how insurance is sold and regulated. You'll learn about different agency systems, key legislation, and the organizations that shape the industry. This chapter is your roadmap to understanding how the insurance industry operates. Let's dive in and get you ready to prepare to pass with confidence.
I want us to listen to this again. Jot something down. If you can, jot something down. This is the introduction. This is the beginning of what we are going to do in the review.
That make the insurance industry work. By the end, you'll be able to complete the following. Explain key insurance concepts such as risk transfer, indemnification, and premium pooling. Distinguish between major types of insurance companies. Identify key departments and roles within an insurance company. Compare different insurance distribution systems. Explain the evolution of insurance industry oversight. And finally, describe the roles of major industry organizations like the NAIC. Let's start with a simple idea. Insurance isn't just a product. It's a promise. Unlike buying a phone or a car, when you buy insurance, you're buying peace of mind. First, you'll learn how insurance companies take on risk from individuals and spread it across large groups. This is what makes financial protection possible. We'll also look inside the insurance company to understand who does what, from producers and underwriters to actuaries and adjusters. These professionals work together to make sure insurance works for everyone. Finally, we'll explore how insurance is sold and regulated. You'll learn about different agency systems, key legislation, and the organizations that shape the industry. This chapter is your roadmap to understanding how the insurance industry operates. Let's dive in and get you ready to prepare to pass with confidence.
All right. So let's go to the keywords. Remember how the process, the way we study? We normally go through the keywords. The keywords are the important, some of the words that we're going to see in the content. Of course, agent. Who is the agent? Agent is me and you. When you get the license, you're an agent. An agent is also called the producer. An agent is also called the feed underwriter. An agent is that first person who solicits, who sells, who transact coverage for specific insurance providers under an agent contract. An agent is that person who are authorized by that specific insurance provider to solicit, to sell, to transact coverage for specific what? Insurance policy. So that's an agent. Please, as you go along, anything you don't understand, say it now so we can trash it out. Broker. A broker is the person who represents the insured. Who is the insured? The client is regarded as an applicant. When he submits the application, is an applicant. He can also be regarded as the client. He can also be regarded as the customer. So that is the insured. He graduates from being a client to being insured. He graduates from being applicant to be insured. He graduates from being person who look for insurance to become, customer. He graduates as being a customer to be an insured. When a policy is issued, that agent, that applicant, that customer, that client is now what? Insured. You now regard him as insured. When you are describing him, he's no longer a client, now he's an insured. So that's why sometimes you see applicant, they use the word applicant. So if you move down a little bit, they see them using the word insured. So the applicant is the insured. Claim department. I mean, let's look at let's look at the claim department. The claim department, remember, in insurance, we talk about apart from the agent, the producer, the producer being agent, there's all in every insurance industry, there is a lot of departments. Apart from the underwriters, we have the finance department, we have the claim department in insurance industry. Remember, why you should be very careful in the business of insurance, you must do according to what the law specifies, is this. I said you can never get a benefit without a loss. Yes, of course, that is 100% correct. There'll be no benefit without a loss. So for somebody who is struggling to get your who's struggling with you about knowing everything about your policy, there's nothing that person can do except there is a loss. There is no benefit except there is a loss. You must have a loss before you think about benefit. So that's why when you are doing business of insurance, you have to be very extremely careful, because those who approve you or deny you are not those who will process the claim when it comes. I don't know whether everybody gets what I mean. Those who process the application, approve or deny your policy, are not the same people who will process your claim when you now decide to file a claim. They are different individuals. So what that's telling us that we should do every business with all sincerity we have. Because when the claim arises, people will go and approve your claim or deny your claim. However, those who approve your policy are not those who are going to do the same thing. So that's why you should be very careful in the business of insurance. You should be very, very careful on how you conduct your business. The underwriters are not the same with those who work in the claim department. So you may say, oh, the underwriters understand. Those who work in the claim department may not understand. So do the right thing according to what the law says. Of course, the insurance we say is a transfer of risk through pooling or accumulation of funds. It's a transfer of risk. Simply, insurance is a transfer of risk. Insured is that person who receives protection under an insurance policy. Now, insured, of course, we've talked about insured. Insurer is the insurance company. The insurance company is the insurer. If you have any insurance company who come to protect you, is that company regarded as insurer? You are the insured. Mutual company, of course, we talk about mutual company. We talk in life insurance, we have two types of company. We have mutual insurance company, we have stock insurance company. We have been discussing that earlier before today. Mutual insurance company and stock insurance company are the two singular type of life insurance. So I think by doing this, you'll be so happy getting to know mutual company, getting to know stock company. They are the two major insurance company. And we said the mutual company is an insurer owned by the policyholders that typically issues participating insurance policy with potential dividends. They are what? Issue participating policies. Mutual company issue what we call participating policies. That's mutual company. What does that mean? If you buy a policy in a mutual company, automatically you become part owners of the company because you participate in sharing the profits. They share the profit to you in form of what we call dividends. So that's why you can see that mutual company participates in the share participating policy. Then in participating policy, you have again non-participating policy. Who sells non-participating policy? Stock companies. Remember, we say we have two types of insurance company: mutual company and stock company. That's the two important types of insurance company. I'm talking about insurance company. I'm talking about policy. Two types of insurance company is mutual company and stock company. They are the two types of insurance company. The mutual company, we say, sold what? Sells participating policy. While the stock company sells what? Non-participating policy. Please, you have to know that. Mutual company sells what? Participating policy. And stock company sells what? Non-participating company policies. So what then is the participating? What then is non-participating? Mutual companies sell participating policy because the providers, that is those who buy policy from them, helps in sharing profit. That's the participating policy. They help in sharing profit. Remember, you cannot only eat. When it comes to bad, you have to take. So you follow them to share profit. When there's any loss, you follow them to share the loss. Yes. So if you can have the power to, and more especially, you have the power to vote. So if you have all those rights, automatically, what it's telling you is this, that your policy, your policy can generate, apart from the cash value, can generate some other thing in it. So we're going to go through them one after the other, but not now. We're going to meet them in the future. So the producer, who is the producer? You. You are the producer, you are the agent, you are the feed underwriter. So don't be confused. Don't see producer if you be thinking that it's the insurance company. No. The producer is you. The agent is you. So these are the things you have to know. Mutual company, stock company are the two major types of insurance company. Mutual company and and stock company. We say the mutual company say what? Participating policy. And what the stock company say what? Non-participating policy. All right. So underwriting department, of course, we'll talk about underwriting department. Everyone should know that. Now, let's look at the concept of insurance. How do insurance work? How does it work? How does it come to be? How does it work? Before we go to the detail, I want everybody to pay attention to this. Let me see whether I can increase the front. All right. So we have tried to increase it. So look at this. I want everybody to look at this. Look at what happened. Before we read this, look at what happened in insurance. See here, is everybody seeing my screen? I hope everybody see my screen. I believe so. Yep. All right, better. We didn't see you. Better, what is going on? I didn't see you yesterday. Miss Better.
Yes, sir.
I said I didn't see you yesterday.
I know.
What happened? When are you taking?
Dr. Ruth knows why.
When are you taking the exam?
I'm still trying to study, sir.
You have to tell us if you have any issue. Let us know. Want to make sure you pass your exam next week. I think you are taking next week. We want to make sure that you pass.
Okay.
So go through it. What chapter are you reading now? What chapter are you into?
I'm looking at the chapter you're talking now.
So what chapter have you been reading on your own?
This one I did. I completed the annuity today.
All right, good. So did you get everything about annuity?
Yeah, it's a lot of content, but yes,
There's a lot of content there.
it's a lot.
Anyway, that's good. We started from chapter 1 today. So
Okay.
that'll help you a lot. We started from the beginning.
Okay.
So you're welcome.
Thank you, sir.
Yeah. All right. So I want everybody to look at this. This is exactly what happened in insurance. What you are seeing is what happened in insurance. This is the policy owner. Let's assume you buy a policy. This is a policy owner. Remember, insurance is a transfer of risk. Insurance is what? A transfer of risk. So you are the policy owner. You are here. You are the applicant. You are here. Now, you decide that you want to sell your, you want to transfer your risk to insurance companies. See, we are insurance companies here. They are here, the blue one, or the blue one. They are here, they are the insurance company. See you here, the policy owner or the applicant, you are there. Now, what the definition of insurance is a transfer of risk. Now, you want to transfer your risk, the policy owner want to transfer his risk to the insurance company. That's exactly what insurance is. Now, you transfer the risk, and again, you are the policy owner. The insurance company requires you to pay a premium. For you to transfer the risk, you have to pay a premium. That is basically what it is. For you to transfer the risk, insurance is a transfer of risk. Then the insurance company said, for you to transfer that risk to us, you have to pay a premium. So the insured pays a premium by transferring risk to the insurance company. Now, let's look at what happens when claims are being paid. When you transfer that risk to the insurance company, you have to specify the amount of risk you want to transfer. Is it 500? Is it 200? Is it 300? That's what you are transferring. That's what you are transferring to buy. I mean, that's the amount of risk you are transferring to the insurance company by paying a specific premium that they want you to pay. So that's policy owner, the premium, and the transfer of risk. This is insurance company. So here is the claim. The claim is how much did you transfer? How much you're gonna get after if there's a loss of that risk, those transferred risk, how much you're gonna get. So that's what we call paying of claim for coverage loss. We said there'll be no benefit without a loss. So here in the paying of claim, you have to be able to define what you do before the claim can be paid. It's not just everybody wake up to go and get a claim. No. The contract must specify what will be the loss before the claim will be paid. Because remember, if there is no loss, there is no claim. Remember that's connotation. So if there's no loss, there's no claim. So that's exactly what happened in life insurance. So the concept of insurance said, for more than a century, insurance has been recognized as an essential element in an individual's or family financial planning program. Insurance helps to reduce the financial uncertainty of the policy owner with regards to possible future losses. So if you do not start with us in this particular chapter, you're going to miss a lot because we are laying the foundation right now. So a financial planning program should include what? The individuals or family general and specific financial goals and the plan to achieve those objectives. Since we are reading this, what is your mind telling you? Your mind is not telling you about insurance. Your mind is telling you family planning program. Your mind is telling you your general family financial goals. Your mind is telling you plan to achieve those objectives which you have in mind. That's exactly what this thing can provide for you. But are we going to specifically say it that way? No. We're not going to say it the way I said it, but rather what it says is insurance helps to reduce financial certainty of the policy owner with regards to possible future losses. But however, through an adequate financial planning, which must come through the policy, that financial plan will include what? Individuals or family general and specific financial goals and plan to achieve those objectives. So that's what insurance is about. No, it's not just if you see somebody, talk to somebody, say, please come and join me, listen to what I'm listening. The person will say, oh, that's insurance thing. Please, it's not insurance thing. No. It's more than that. What we are seeing, doing here is more than that. So we're going to use this chapter to review the basic principle, nature, and legal concept of insurance contract. In general, the contract of insurance may be defined as transfer of risk from one party to another through a legal concept. through a legal, it's not just transfer risk like that. It must be through a contract, meaning there must be a legal contract. So when purchasing insurance, a policy owner transfer is the risk of large financial losses to an insurer by paying a small premium. Transfer the risk by paying a small premium. They don't collect the risk by free because their risk is a very big load. So the load now depend on how much you're going to pay for them to open the load. All right. So the insurer then pulls this premium from when you transfer the risk, you pay premium, the insurance will go ahead and collect the premiums, the pools of premium from every other policy holders to spread the risk. Now, when you pay the premium, remember the premium can be used in different things. That's why in most insurance companies, you don't have what we call return of premium rider. Probably the premium must have been used for something. So when a transfer of risk is accomplished by purchasing an insurance policy, the policy owner obtains a large quantity of coverage in return for a small fee, that is the premium. Imagine you are using a small premium to buy a large quantity of coverage. What is that large quantity of coverage? Who can remember? Who understand what they mean by buying a large quantity of coverage? Using a small fee to buy a large quantity of coverage. Who understand what that means? Anybody can contribute? Using a small fee, which is the premium, to buy a large quantity of coverage. What does that mean?
I believe it means that, when we are buying policy, we are paying the amount that we are putting down, the amount that we are putting down, which is the premium. God forbid if something happens, it does not equal the amount of the benefit that will come out of it.
Yeah. So you are very correct. Yeah, we are using small money to buy big money. That is what it means, using small money to buy big money. You can't equate what you will get, the money that come out of it. You can't equate with the money you are using to buy that money. The premium, you can't equate it. However, we don't even want to go there because that's the fear all of us have before now. The fear of death. That, it's only when we die. No, it has transferred. It have gone beyond that. It's not only when we die. It's again, including when we die plus when we are still alive. So it's not only when we die, because that's the fear everybody have. Oh, it's not that one, that thing. Only I will eat it when I die. No. Nowadays you eat it while you're alive. So that's the beauty of it. So using some people will say, like this meeting we had yesterday, teaching we had yesterday, somebody say we are buying using money. I get how the person put it. I can't remember. I get how he put it. Say using buying weights. So we are using small money to buy weights. Of course, that's what it is. Remember, everybody must die one day. There's no two about that. There is no two. In fact, it's written. I think when what's that last? Those who read Bible here, what's that last quotation? The quotation by Satan. There's one quotation Satan made when he was trying to tempt Jesus. I'm sorry for those who are not Christians. For those who are Christians, there's one reference that Satan made in the Bible. Satan quote Bible, say, Son of God, it is written. So it's generally written. But what we are praying is that God preserve us, let us live at least to see what we have suffered for. That's the prayer for everybody. We want to live at least to experience what we have suffered, to eat the fruit of our labor. That's basically what life is all about. So it can come, it can go. So the earlier we start to prepare for it, the better. The earlier we understand that, look, this place is temporary, the better. So the need for you to have a policy that can take care for you if there's any emergency. that can take care for you if you are sick. People don't understand. People still see it as if we are joking. Honestly, we are not joking. You don't want to lose that job. I mean, you don't want to lose that home if anything happens. At least that home. At least, if not other thing. Because you can't live in the road now. My friend, you can't live in the road. And you can't live in a home, live at home where you live comfortably. You now want to move to apartment. And even if you move to apartment, under sickness, can you be able to pay for the apartment every month? You cover up to 1,000 or 2,000. Is it possible? It's not possible. Oh. It's not easy. So let's assume you're paying that 1,000 when you are still strong. What of when you are sick? How are you going to pay that 1,000? So insurance is the transfer of risk from one party to another in exchange of the payment of premium. That's what insurance is. From one party to another in exchange for the payment of premium. We, the insured, we pay them premium. So that's what it is. Now, let's look at solutions to economic uncertainties and losses. Remember what we read before, that what we purchase is we purchase solutions to economic uncertainties and losses. That's what we buy. Remember the scenario that said you can go to market and buy television, and that before you go, you have known what you are going to buy. You know exactly what you're going to buy. If you're going to go to market now, you and your wife or you alone made up your mind that, oh, we don't have television at home. Let's go to market and buy television. As you're going, you already know what you're going to buy. You know the amount. Of course, you may not even the amount. You know the amount. You know the product. You may even know how to use it. How to use it. You may not even need a product guide to operate it. You already know how to operate it. But in life insurance, we are going to market to buy a promise. That's what we did here before. We go to market to buy a promise. And what that promise for? That promise, the promise that pay us for any uncertainties and losses. So imagine somebody's you're alive and you're not afraid of losses. You're not afraid of uncertainties. I think you breathe well. I'm telling you the truth. So most insurance contracts pay off financial losses and reimburses the insured. The insurance contract indemnify policyholders by restoring them to their financial position before the insured losses. That's indemnity. Insurance contract indemnifies policyholders by what? Restoring them to their financial position before the insured loss. Who is the policyholder? That person who buys the policy. The insured is the policyholder. Remember what we said, that the insured can be the policy owner, and sometimes the insured is not the policy owner. That's what we said. By definition, what it means, the insured is the policy owner, is when you, the insured, buy the policy, you are the insured, you are also the policy owner. But what about when you are the policy owner, you pay for the premium, but the policy, you are not insured, which means let's assume your children or your cousin or anybody or your mother or your father, even anybody is insured, but you are the policy owner. In that time, we say the policy owner is not the same as the insured. So indemnity is that the insurance company is trying to restore you, trying to put you back, trying to bring you into focus to a position where you are before you have the loss. So that's basically what the insurance company does. Even though the amount they're going to pay you may not be equal to what the loss you have, more especially when you're talking about life insurance. No amount of money is equal to a head. To the person who passes or the person who is sick, no amount of money is equal to it. No amount. Of course, that's why they said life insurance contract is a contract of unequal value. If you remember, it's contract of unequal value. So the principles of indemnity states that the goal of an action is to restore an insured to the same financial position they were prior to when the losses in question occurred. I think everybody should know what indemnity is. The principle of indemnity. Just know that they are trying to restore it to original position before the loss occurs. That's what it is. That's what you need to know. So the insurance contract indemnified the insured. Indemnification is the principle of indemnity. It's also, indemnification also holds to the principle that an insured shall not profit or gain from their loss. So in your auto insurance, if you have an accident today, let's assume you have an auto accident, they're going to come and they'll quantify it. And let's assume you have headache. You're going to put it there. But if you don't put it there, are they going to cover it? Of course, no, they're not going to do that. So they are trying to indemnify you to bring you back how you did before the headache. So insurance contracts indemnify insured. Indemnification also holds to the principle that the insured shall not profit or you're not going to make a profit. You're not paying, they're not paying benefit for you to make profit. No. They're paying you exactly what the loss is all about. In life insurance, if the policy amount is 500, they will not give you more than what you have, except you have cash value. But term life insurance, you made a term life insurance of 500,000. If there's any loss, they will hand you over that 500,000. So compare it with annuity. If you go and buy annuity of 500 today, it's not going to be, when they're paying you during the amortization, they're going to pay you principal plus profit. All right. So let's go up, let's go up, let's go up. So let's look at types of insurance company. Types of insurance company. We said before there's two types of insurance company. Please note this in. We are not talking of policies. We are talking of types of insurance company. It's not policy. How many insurance company operate sales insurance? There are two types of insurance company. There can be different types of insurance company, but all of them are classified based on these types of insurance company. There can be mutual company and there can be what? Stock company. And there's no that one. Then he said the term insurance company or insurance carrier or insurer are used to refer to an entity or organization that provide insurance services. Organizations that provide insurance are broadly categorized into private, which is commercial insurance company, or government providers. Or commercial insurance or government providers. Basically, you're looking at stock and mutual. So let's look at the private insurance or commercial insurance. The private insurance or commercial insurance is for what? Private citizen or group owned commercial insurance company, which may be appropriate or cooperative. Proprietary or cooperative. I don't know anybody know about cooperative society. So an example of a proprietary insurer is a profit-motivated stock company. So stock companies are profit-motivated. They go with an intent to make profits. That's stock company. So this private insurer offer individual, group, industry, or blanket insurance policy. We're going to see what's called blanket insurance. We're going to see it in the future. So now we have talked about stock company. Let's go to what? The government social insurer. Remember we said social security is an insurance, government insurance. HMO, PPO, all of them are government insurance. So government social insurance, government, federal and state government also offer a variety of coverage, commonly referred as social insurance. Social insurance program range from crop insurance to FDIC insurance on bank deposit. So in case of exam, a company providing the insurance is referred to as the insurer, while the person receiving coverage is known as the insured. So let's look at private insurance company. So commercial insurers are private insurance companies that offer many lines of insurance. They are now, you're going to now see clearly the two types of insurance company that we operate on. They are the what we call commercial insurer. So some only sell life insurance and annuity, while others only sell accident and health insurance, or strictly property and casualty insurance. So companies that sell more than one line of insurance are referred to as what? Multi-line insurer. Please know that multi-line insurer are those companies that sell what? More than one line of insurance. They are multi-lines insurance. A company that only sells one line of insurance is considered monoline insurer. So multi-line insurer are those companies that sells more than one line of insurance. So monoline insurers are those who said only what? One line of insurance. Is that clear? Monoline and multi-line insurer. The multi-line says more than one insurance. The monoline said what? Said only one single insurance, monoline. So stock and mutual companies can both be considered commercial insurance as such. Both can write life, health, property, and casualty insurance. So you see what you're going to write? When you get your license, see what you're going to write? Life, health, property, and casualty insurance. That's what we're going to write. So now let's look at the two major types of insurance company. We're now going to see they are considered a commercial insurance because they say they can be monoline, they can be multi-line. When they are multi-line, they're selling different kind of insurance. When they are monoline, they are selling what? Single type of insurance. So please, I want everybody to don't get confused, please. You see, we are taking it gradually, so you know all this in step by step. So let's look at the stock company. Remember, we talk about stock company and mutual company. Let's look at the stock company. We say stock company sells what we call non-participating policies. Stock company sells what we call non-participating policies. So I know the question in everybody's mind is that what is non-participating policy? Of course, I've said that several times. What you mean by non-participating policy is that, look, if you have a policy in a stock company, you are not participating in sharing the profit. The profits are shared by the stockholders. So that's stock companies. So companies are publicly traded commercial entities organized and incorporate under state laws to make a profit for their stockholders, shareholders. So you have to know the stock company, they say non-participation policy, and why they say non-participation, why we call it non-participation? Because they do not participate in profits. They only sell the product and go their own way. That is stock company. If you have policy with them, you do not participate in sharing of profit. Who participates in sharing of profit? Who? If you do not participate in sharing profits, who participates in sharing profit in stock companies? Nobody knows?
Say that again.
I say, who participates in sharing if stock companies are non-participating policy, which means you as a policy owner does not participate in sharing the profit.
The stockholders.
The stockholders.
Oh, the stockholders or shareholders, they are the people that participate in sharing profit in stock company. That's why they say non-participating policies. So the stockholders or shareholders participate in sharing the profit in the company. So if you have policy on stock company, you just pay your premium and go your own way. They don't want to know whether you exist or not. They don't pay any dividend. Then if you turn around to go to mutual company, you buy policy in mutual company, what do you see? They say what we call participating policies. So stock company says non-participating policy, mutual company says what we call participating policy. And why are they called participating policy? Because you as the shareholder, you will participate in sharing profit for the year. you will participate in sharing policy if you buy policies in mutual company. So let's assume you buy policy from mutual company. Buy fixed index insurance, maybe around 500,000 in a mutual company. And you are paying probably $400 or $300 every month. You are preferred and you are 55 years old. You are paying $300 every month. Now you are paying that money and you bought that policy in mutual company. So every month you pay your money until every year ended, just like as year ended. The mutual company will go and calculate their income, calculate what they have spent for the year. That's what they calculate. If they calculate, see that they made a huge profit, they made a huge profit, you have already gotten something out of there because the profit will be shared among the policyholders. Yeah, the profit will be shared, and they share the profit, they give it to you in form of dividend. They give you the profit in form of what we call dividend.
Dividend.
Yeah, dividend. So imagine you buying that policy, 500,000, you are paying $300 every month. And it's a cash value life insurance. Remember, you have what we call the cash value, which comes from the premium. It's going there. Now, every year, this company will now share their profit, and they give you the profit in form of dividend. And remember, you don't pay profit, you don't pay tax on dividend. I hope you know. Yeah, you don't pay tax in dividend, but you pay tax on the accumulation. You pay tax on the accumulation of dividend. So you are getting something from the cash, the accumulation of the cash value, and you are getting this one that's quite different from everything. Every year, if they make profit, you are among the people that will share the profit. So now, they give you the profit. Let's digress a little bit. Let me go deep a little bit so you can write something down. Please write something down, because most times you see it in exam. So this dividend they are giving to you, this profit you are following to share is in form of, they pay it to you in form of dividend every end of the year. Those who have mutual company, who have the policy of mutual company, should go and check. Now it's February, they must have shared if there's profit, they must have shared the dividend to you, the profit to you in form of dividend. So when they share this dividend to you, you as the policy owner will now decide what you want to do with the dividend. You can do 4 things with the dividend. Four things that you can do with the dividend. Please note it down. The dividend given to you by the mutual company, you can decide to what? Cash it up. You can cash the dividend and take the money. You can decide to say, I don't want to put it in, just give me the money. They give you that dividend. 2, you can decide to accumulate the dividends. Accumulation. You can decide to say, oh, I don't want it. Anytime you get the dividend, save it for me. You can accumulate it. 3, you can use the dividend they give to you, use it to pay, if it's good to pay the premium, you can use it to pay the premium of the policy. So you can use dividend accumulated to pay the premium. The last one, the 4th one is this. You can use the dividend to buy more policies, more especially term policies. So did everybody understand the 4 ways you can use the dividend? Please note it down. It's an exam question. Note it down, please. So the individual stockholders provide capital for the insurer. In return, they share any profit or losses. Management's control rests with the board of the directors selected by the stockholders. The board of directors elect the officers who conduct the daily operation of the business. If the cash dividends are declared, stock insurer will make the payment to their stock or shareholders. Dividends are paid to the shareholders are subject to taxes that are similar to long-term capital gain taxes. Dividends are subject to taxes the dividends are not being taxed. What is being taxed is the interest on the dividend. So stock companies seek to grow their post-tax earnings and surplus or retained earnings that are not what? Paid out of form of cash dividends. Earnings that are retained by the company are considered equity and are owned by the shareholders. So stock companies issue non-participating insurance policies. Non-participating policies do not pay policy dividend because the policy owners are not the owners of the insurance company. Also, the purchase of non-participating insurance policies does not confer any other ownership privilege, such as this and that, electing the company's board of directors. So let me tell you, there's one good thing about, I so much like mutual company, honestly. You know, apart from them sharing the profit with you, they also give you the right to elect the board of directors. If you have policy with mutual company, they equally, apart from sharing the profit with you, they also tell you to give you the power to elect board of directors. So when a company does those things to you, are you not the part of the company? Your prayer will be this company should continue to make profit. So let's look at mutual companies in detail. So mutual insurance companies are also organized and incorporated under state laws, but they have no stockholders. They don't have any no stockholders in mutual company. Therefore, ownership rests with the policy owners. So because mutual companies do not have stockholders, ownership now depends on the policy owner. Those who own policies are those who own the company. So any person who purchases insurance from a mutual insurer is both a customer, that is policy owner, and an owner of the insurer. Did you guys see that? Can anybody read on his own can you just put it down, what I just highlighted? It said any person who purchases insurance from a mutual insurance company, is both a customer, of course, and what? I hope everybody got it. All right, the policy owners vote for board of directors. So if you're a policy owner, you vote for board of directors, which in turn elects and appoints the officers to operate the company. So that's exactly what it is. So but however, one thing I will take to scare you there now is to let you know that when you participate in gain, you also participate in loss. So let that balance what you want to do. Stock company has a very big advantage if you go into details too. And also, mutual company has more advantage that we can discuss, but not with the level of what we want to do. So the policy owner votes for board of directors, which in turn elect or appoint the officers to operate the company. Funds remaining after paying claims and operational costs may be returned to the policy owners in the form of policy dividends. So you pay a premium, money is diverted, is spread across, as we said, when you pay a premium, your money is assigned to so many things, including your reserve for tomorrow, your income, on all the rest. When that is done, the remaining one, if there's any return, any remaining, or that can be returned to the policy owner. So you can see how this is so good in the form of policy dividend. So dividend from a mutual company may never be guaranteed. Also, it is not guaranteed. Also, mutual company dividends are not taxable. Did you guys see it? Mutual company dividends are not taxable. You see where I highlight? Mutual company dividends are not taxable. They are tax-free. However, the interest on the dividends are taxable. So that's the area I don't too much like. They would have not taxed the interest. So these policies are known as participating per contract because the policy owner participates in the distribution of dividends. All right, so let's look at divisible surplus and divisible surplus. What is the divisible surplus? Said stock insurance companies are some of those profits to pay, using some of those profits to pay stock dividend to their shareholders. Mutual insurer hold their excess earnings as a divisible surplus, which they return to their policyholders. Did you guys see that? When you pay your premium, they use they do all their expenses, the remaining one, they return it to you. Those ones they return to you, how they return? They return, the company now use it to spread to everybody to use it for us as a guide. So divisible surplus is what is the amount of earning paid to the policy owner as dividends after the insurance company set aside funds required to cover reserve, operating expenses, and general business purposes. So that part of the money they return to you after all the expenses, all that money they return to you is called divisible surplus. Please, I want everybody to know that. So policy dividend represents a partial refund of premium remaining after the company has set aside the necessary reserves and has made deduction for claims and expenses. So mutual companies typically distribute policy dividend to policy owner on an annual basis. So you can see how good mutual company is, please. If you need to go by. In life, I mean, in annuity, remember we talked about mutualization, amortization, and the contribution and accumulation. Remember we do that. So how many companies we have? Two. The mutual company, for your own exam, how many companies we have? Two. The mutual company and stock company. We say the stock company says what? Non-participating policy. And the mutual company says what we call participating policy. You have to know why are they called non-participating policy and why are they called participating policy. The non-participating policy means that you, the policyholder, does not follow them to share profit. That is what stock company. The shareholders share their profit. The stockholders share their profit. The participating policy is mutual company. You follow them to share their profit in form of dividends. And at every year, they calculate all that they have spent. They use it to buy all the things they're supposed to buy, including funding of everything in the company. So whatever remain is what they distribute it to the policyholder. That's what we call the surplus, divisible surplus. So please know that. Now, let's dive into when you want to transfer mutual company to stock company. If a stock company existing, you want to make it a mutual company. If a mutual company exists, you want to make it to stock company, you can do that. So mutualization and demutualization. So mutualization is mutual companies can convert to a stock company. When you are converting a mutual company to stock company, it's called what? Mutualization. Mutualization is the conversion of mutual company to stock company. It's called mutualization. Then demutualization is what? Is when you do the opposite. You are converting stock company to mutual company. It's called mutualization. You are converting mutual company to stock company. It's called what? Demutualization. Did everybody get it? Maria, are you here? Maria, are you here?
Here.
All right.
Yes.
All right. I hope you are getting it. You are writing it down.
Yes, man. Yes.
All right.
Yes.
So mutualization and demutualization, I want everyone to know that mutualization is what? When you are converting stock company to mutual company, it's called what? Mutualization. Now, when you want to convert mutual company to stock company, it's called what? Demutualization. Of course, we say that mutual company says what? Participating policy. And stock company says what? Non-participating policy. So you should know that. And you should know what divisible surplus is. All right. So these are the exam tip. This is basically what you're going to see in this chapter. The exam tip: participating policy allow policyholder to participate in the company by electing the board of directors and receiving dividends from the divisible surplus. Mutual company issues participating policy. That's what you need to know in this chapter. Then non-participating policy do not allow share policyholder to participate in election or receive dividends. Stock companies issue non-participating policy. That's what you need to know. So a company that issued both participating and non-participating policy operates under a mixed plan. So a company that operating both participating and non-participating policies operates what we call a mixed plan. Of course, you know what mutualization and demutualization is all about. So let's look at fraternal benefit society. Fraternal benefit society. Fraternal benefit society. I hope some people is writing down those things. Please write down. I will now help you to remind you. Please do not write down, please.
Paternal.
Yep. You have to write down what is mutualization, demutualization. You have to know what it means, please. All right, let's look at fraternal benefit society. I normally like to use my home, my place, my association here as an example of fraternal benefit society. So, sorry, please. A second, please. All right. Sorry. So fraternal benefit society are what? Are noted primarily for their social, charitable, and benevolent activities, but they also issue insurance to cover their members. These societies have membership that may be based on religion, nationality, or ethnicity. All of us here are immigrants. I hope everybody here is immigrant. Except Maria. Maria is not an immigrant. Maria, are you an immigrant?
Yes. Yes. Yes.
So all of us here are immigrants, meaning we come from somewhere. We migrated to America.
Coming straight from Jamaica.
Or we come from Jamaica. Which city you come from? Which city part of Jamaica?
Clarendon.
Huh?
Clarendon.
Farinda. I went to
Clarendon.
Clarendon.
Yes,
I went to
that's southeast to towards the north coast.
Damascus. I think I went to see Jackson something. I don't forget the place I went. I went
In Clarendon, Jackson Bay.
Jackson Bay. I went to Jackson Bay. Yeah. So I have to use I have to order taxi to take me inside Jamaica. Inside.
Mm-hmm.
I have to go to Bob Marley place.
Oh,
I went I went everywhere.
St. Anne.
Huh?
That's St. Anne.
Yes. I have to go to that place. I brought a taxi. I rented a taxi. I have to go from my hotel, take me from my hotel to everywhere. The man driving,
Everywhere.
I'm telling you.
No problem, man.
As we are driving, we're drinking coconut water.
Coconut water.
We're
Did you
drinking.
enjoy? Did you enjoy it?
Yeah, it's good. We're drinking coconut water. We are eating banana. We're
Jerk,
eating a lot of things.
jerk pork, jerk chicken.
Yeah, because but Jamaica is all basically like Africa. All those natural
Yes,
things we see in
same,
Africa
same
is
thing,
also in
same
Jamaica.
way. It's the
Yeah,
same thing.
that's the same way. So
Same.
it was fun. I wish to go there one of these holidays again. Yeah.
You're
So and
welcome.
you know what take us to Jamaica? Is this business that take us to Jamaica?
Really?
Yes. We went there. Everybody went there for holiday. All of us as a group, they pay for that trip. They pay for the trip.
Wow.
Yes,
Are
they
you
pay for
kidding
it.
me?
Yes. We are in one this thing, I forgotten the place. Oh my God.
Holiday Inn Hotel?
No, no, no. The hotel we are in is
Oh,
very inside. That you enter there,
uh-huh.
enter the very big place. Everything is paid. You just
Mm-hmm.
enter, you eat it anytime, anything or like anytime, oh my God, it was fun. It was fun.
Mm.
Yeah.
What?
The business
Y-
took us to Jamaica. Yeah. The first time I went to Jamaica is a business. That was 2 or 3 years ago. 2 years ago, yeah. 2 years ago.
That's impressive. That's really nice.
Take us to Jamaica.
Wow.
It's a very fun. I love them. It's just like in Africa, I'm telling you.
It's the
Their
same.
forest is not like as Africa. Everything about them is just like Africa. I'm telling you.
Mm-hmm.
Sometimes they get a lot of hills. Hills. You climb the
Hills, yeah.
yeah, hills.
Mm-hmm.
It's fun. It's fun.
I'm glad. And
And
you're going to Hawaii too, right?
yeah, we're going to Hawaii on Saturday. We'll be 2 weeks there.
Wow.
Yeah.
Wow.
And
Congrats.
we're going for boat cruise. When we come back from Hawaii, we're going for boat cruise.
Mm.
All right. So this is why I've come to that discussion now is that all of us here come from a particular place. And in that place we come from, we are here as an immigrant. We have a small unit called our association or organization that we belong to in this place. Me, I'm come from Nigeria. I'm from Imo State. We have a local organization here where people from the same local government area is, or where people from the same state is, or the people of the same ethnic regions. So all those are fraternal benefit societies. So, for instance, I'm from Idato. We have what we call IPA, which is Idato Progressive Association, meaning everybody that lives in Dallas that's from Idato belongs to that association. Yes. So, that association is what you can call a fraternal benefit society. So that's why I say all of us here are immigrants. All of us are immigrants. Every place you come from, you belong to a particular set of association. Even Maria, you come from Jamaica. If you check around, you see that there's a group of Jamaicans that form an organization. So
Mm-hmm.
those organizations are called fraternal benefit society.
Okay.
So the fraternal benefit society, not apart from doing social, they are formed primarily for social, charitable, and every other benevolent activities. They go as long as buying insurance to cover their members. So for me, the association we have, our local association here, we decided that we should go equally to buy insurance for our members.
Mm-hmm.
What I'm telling you is real. So we brought in an agent to speak to us. The agents speak to us. We said that go and give us a quote. We want to know how much it costs us for all of us here to have an insurance. So when the man brought the quote, we saw it is too much. It's much, much pricey. And the reason is this. They took the average age of all of us because at that point, they tell us to submit your name. You write your name, you write all your age and all those things, We thought it was fun. Everybody using their driving license was writing all those things down. They now give us a quote. The quote they give us, using an average age for all of us, the quote they give us was much for us to be able to pay monthly. So we could not go ahead with the insurance. But a fraternal benefit society apart from they are formed for social, active, charitable, or benevolent activities, they equally provide insurance coverage for their members. So that's what Fraternal Benefit Society is. They have membership that may be based on religion, nationality, or ethnicity. So your own may be based on religion. For some people who go to church too, their own is based on religion. For some people, their own is based on their nationality or ethnicity. So that's Fraternal Benefit Society. They are formed not mainly because of insurance, but they are formed because of social and charitable and benevolent activity. They now go ahead and provide insurance coverage for their members. So Fraternal Benefit Society have existed in the United States for more than a century and first began offering insurance to meet the needs of their low-income members. So, like where we come from, when we hear the word fraternal, who is here from Nigeria? I think Shei has gone out. I think mostly everybody here from Nigeria. If you're from Nigeria, I hope so.
I'm Nigerian.
All right. If you are from Nigeria, I hope.
I'm from America.
All right. Welcome, American lady.
I'm from Imo State, yeah.
All right. So when you are in Imo State, when you grow up in Imo, you grow up in Alibo, in Imo State, in Nigeria.
When Igbo too. I'm Igbo.
Where if you from?
If he is Igbo now.
No, you yourself. I'm Igbo.
Me?
Mm-hmm.
Complete in one for.
Oh, yeah? I'm from Imo State too.
Oh, really? What part?
Molo.
Oh, my God. Oh, Mama.
I'm from Kwara.
Oh, my goodness.
I school at St. Augustine, Kwara.
Oh, wow.
Closer to my village.
I school at St. Augustine, Kwara.
Oh, wow.
Then for our mama, I know a lot of our mama. I know Chief Ugweru. He just died. He's just turned 90 and died. He died last month.
Wow.
Ugweru, Chief Ugweru, Silakus Igweru or Silvanus Igweru. He's Callistus Igweru. Yeah.
My mom there.
Yeah. He's from, I've forgotten the, is from our mama? It's from.
They live in Dallas.
No, they live in Nigeria. But some of his children live here too.
Okay. My mom.
Yeah, I know the family well. So what I'm trying to say is that if you come from Nigeria, you see this word fraternal. When we hear it, we thought it's a secret society. Who can relate? If we hear the word fraternal, it's a fraternity. we say that.
I think it's like a court.
Yes, we thought it's like, we say it's a court. Fraternity, it's a court. Yes, it's a court. In those days, I school at University of Port Harcourt. In those days, fraternity. Oh my God, we are so scared with that name alone. You are scared of it.
It's a court.
Yeah, it's a court. But here, it's not a court. This is an organization. Just like as I speak now, I'm saying our own organization here, which is IPA, Idato Progressive Association, we are not formed to go and get insurance. We are formed to help ourselves. We are formed to do social and charitable and benevolent activities as member of the same ethnic group. But at the point, we decided that, look, since most of us, sometimes people will die, we could begin to contribute money. We said there's no need for that. Let us buy a life insurance whereby every member will be covered. See? So the essence of buying the policy is to make sure that every member is covered. So that's exactly what Fraternal Benefit Society does. That's what it does. They buy insurance for their members. But
like a sisterhood.
Yes. Does it mean that they are formed to buy insurance? No, they were not formed to buy insurance. They were formed for different things because at the point, they decided they're going to get a policy for their members. They're going to take care of their members. We tried it, but the quote they gave us was much, which means the premium we're going to pay was much more than what we can afford. So we did not go ahead with the plan. But we brought an agent who spoke to us, who collected our information, and now come back after about 2 or 3 weeks. He come back with a quote, which is more than what we can afford. So indirectly, what I'm trying to say is that in that case, we are like fraternal benefit society. So as every other organization here in the US, as far as you are an immigrant, you have a fraternal benefit society. So fraternal benefit societies have existed in America for more than centuries and have become, and they start giving insurance, offering insurance to meet the needs of their lower income members. They give insurance to their members. You know, here in America, if you belong to any fraternal organization, definitely they know how to do it. They must cover you with insurance policy. But did they form to provide insurance policy for their members? Not at all. They were not formed to provide insurance for their members. So let's look at the characteristics of fraternal benefit society. The organization must have the following. For you to be regarded as a fraternal benefit society, you must have the following. You must be a non-profit organization. Most of our organizations over here, the non-immigrant formed, are non-profit organizations.
Non-profit.
They are non-profit organizations, which
Mm.
we call, their IRS code is called 501c.
Yeah,
50 They are
501c.
501c, yeah, which means they are non-profit organization.
Mm.
They are not formed to make profit. They are non-profit organization. They have the IRS code is 501c.
If we give back to something every year, we have to do something, right? That's something we.
Yes, those things we are doing is what make us an organization. Is what make us what we are. Remember, we are a charitable organization because we are non-profit organization. So for these people, all these it's just like some of us are not using it well. Some of those organizations we have here are not using it well. For this non-profit organization, if you donate any money to your organization over here, because they are 501c, they give you paper you can use to fight tax to claim the money back. But all those dues we are paying, the dues we are paying to be a member of this local organization, we're supposed to collect it back from our tax. Yeah, it's supposed to be every year, the organization, since they are 501c company, every year they should issue you paper you're going to use to fight tax. It's just like churches too. The offering you give in church.
The church give
But they
paper.
don't.
No,
Huh?
my
They
church
don't.
give. My
Yeah,
church
gives. Yeah, because they are 501c companies.
No, my church give.
Yeah, they are 501c companies. They are non-profit organizations.
Oh, come, my church is African church. It's a
Yes.
Nigerian church.
Yeah, they give. They give because
we get there.
yeah, because they are 501c, they are non-profit organizations. So they give you those forms based on the contribution you make every year.
They don't give us.
Then you have to go and ask your pastor. Your pastor don't know what he's doing. In my church, they give.
My church give.
Yeah, every year they give. Every year they calculate how much you have contributed. They give you paper.
Mine does too.
For you to go and fight that. So any church that are contributing, the pastor is not giving you guys, or the Reverend Father is not giving.
Paying your tithe or your offering, sister.
Yeah, you guys should go and hold him. He doesn't know what he's doing.
They said it, when you give it, you don't give a check or something. You don't give you just giving just offering on the cash.
Whether
when you give cash.
Your tithe, especially the tithe.
If you give offering, if they give you paper, you give offering, they write
envelope,
your name. Envelope, you write your name, give offering.
Everything.
They calculate it for you.
Your phone number.
Yeah,
they have been using us there.
If you give tithe, you put it in an envelope, write your name, they submit it to church, they will record it for you. At the end of the year, they will give you a paper to fight tax. That's why they are 501c company. Yes. My own, they give every year. They calculate it and give it to you, that envelope, for you to fight tax. Yeah. So any money you give to the church here is not a waste. You're going to get it back. As far as the church that's giving you paper during tax at the beginning of tax year. So it must non-profit organization or fraternal benefit organization must exist for reasons other than obtaining insurance. That's the characteristics. There must be non-profit organization. They must have a large system that includes ritualistic work and must maintain a representative government form. with elected officers. Ritualistic work is not ritual. Our mindset, we say it's ritual. Ritualistic work means that all those things we are doing, probably we are doing holiday party for our children, like my own, my organization, what we are doing, my session here, what we are doing that every child, immediately you enter college, you are given $250 to buy a shoe. Immediately you finish high school, enter college, we will issue you $250 check. We say use it to buy shoe or buy pencil for your school. So that's ritualistic work. Anything they are doing, it must be steady, constant. So that's one of the ways we spend the money. If we connect from people, we spend it that way, we issue the paper to go and fight tax. So today, most fraternal benefit society issue group insurance and annuities with many of the same provision found in commercial insurance policies. So fraternal benefit society are more concerned about maintaining minimum reserves and surpluses for coverage than providing dividend and profit. However, dividend may still be paid out to group members under certain circumstances. So if you are paying money to come to any church and you're not giving your paper, they are somehow cheating you. It's not good. It's not good.
No good.
Yeah. So example of fraternal benefit society include the words Independent Order of Frosters or the Knights of Columbus. These are the example of fraternal benefit society. Knight of Columbus. I think those Knights of Columbus are seen in Catholic Church. Independent Order of Foresters. These are societies. Yeah, they are fraternal benefit society. They are not formed to provide insurance. They are
Okay.
They are not formed to provide insurance. However, they are formed to provide insurance for they are formed to do some other things, not because of insurance, no. But in essence, they try to provide insurance for everybody, or more especially for the low-income members in their organization. So that's what they do. So all those organizations are called fraternal benefit society. Reciprocal insurance. All right. So let's look at reciprocal insurance. A reciprocal insurance is an unincorporated organization overseen by a board of governors or directors in which individual members also referred as subscribers. Remember, when we do health insurance, HMO and PPO, those who they call them subscribers. I hope you remember. They call them subscribers. Yeah. The HMO, PPOs, if you insured with HMO or PPO, you are regarded as subscribers. So now we are seeing subscriber here, which is what for reciprocal insurer. The reciprocal insurer is an incorporated organization overseen by board of governors or directors. Just this as organization. So each of the members is regarded as subscribers. They agree to insure one another. For reciprocal insurer, you insure me, I insure you. You insure me, I insure you. That is what reciprocal insurer. They are reciprocal insurer. So it's an organization whereby every members of that organization insure each other. And in that organization, they have what they call the board of governors or directors. So in case if you see reciprocal insurer, what do you mean that reciprocal? Reciprocal means you do me, I do you. Insure me.
God no go vex.
Huh?
I say, do me, I do you. God no go vex.
Yeah, that's what it is. That's what reciprocal insurer is. You buy insurance for me, I buy insurance for you. So each member has person to buy insurance for.
Patronize each other.
So that's to help each other. That's what they do. So unlike mutual or stock insurance policyholder, the reciprocal policyholders themselves insure each other's risk.
How are you?
Policy don't transfer this risk to a separate corporate entity. Instead, each policyholder individually assumed to share assume a share of the risk brought to the company by another individual covered by the reciprocal insurer. So this arrangement makes the reciprocal insurer, a risk-sharing mechanism rather than a form of risk transfer. So in reciprocal insurer, they do what? They share risk. But in life insurance, what we do, we transfer risk. So the only distinct thing about this type of insurer, reciprocal insurer, is that each of these members, they have board of directors and board of governors. They equally have what we call the attorney. The attorney is the person they elect to be able to coordinate this transfer, this sharing of you buy policy for me, I buy policy for you. They elect an attorney to oversee that. So that's what they do. What we're going to do now is assessment mutual insurer. This one is not, I don't think is all that important for us to waste our time here. Captive insurer. Yeah, this one is very, very, very important for all of you, because tomorrow you go to hall and pass the exam. Don't be a captive insurer. Don't be a captive agent. So a captive insurer is an insurance company that only specializes in one group of insurers. A captive agent is you who specialize, who will only be doing business with one insurance company. You cannot do business with any other insurance company. You are regarded as a captive agent. But being in WFG, you are an independent agent. But let me tell you, when you pass the exam, some of us, we are in the group, we are about 30 that are writing the exam. I mean, we are about 40-something, or 50-something that are writing the exam. Now, what remains is about, I think about 20 or 18. All others has passed. So those who are passed, immediately you pass, they issue your license. In the next day, you see people will be calling you. They'll be getting called for those who want to say they want to give you a job. Those who want you to come and work with them. Now, you may not know when they enroll you, just like if you are old, around that kind of 70 years, you have Medicare. You see, sometimes people from HMO or people will be calling you. When they call you under discussion, you don't know when they sign you on. Yeah, that's what they do. You don't know when they sign you either to HMO or PPO. That's the basic truth. You are discussing, they're asking you question small, and you'll be happy when they say they are managed care. They want to know.
You know what happened? Excuse me. What happened to me? They sent me a Medicare Part Advantage, right? So I called them up. I said, who applied for this? Why did I get this? And they were telling me talking nice and da 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 da. I said, okay, all right, it's all well and good, but when did I apply for this? And who did I speak to? You know what she said? She said, oh, let me check with my supervisor. So somebody come on the phone, some guy telling me in the profile, they see where one of their agent met me on the street, and we had a long conversation, and that's where their agent signed me up. I said, listen to me, I ain't stupid. I ain't getting off my head. You gonna cancel this now. And then if they're gonna tell me it cannot be canceled like that, I have to write
Oh
a
my
big letter. I
God.
said, what?
But that's the
I
truth.
said, what? Yes, miss, and nothing go like that. Nothing go like me and nobody don't talk on the street. Nobody can. I don't go outside much because I don't walk properly. So I stay in. If I don't have help, I don't go much. So everything, that's all a lie.
Oh my goodness. Yeah,
So
too desperate.
what he's telling you is true.
So,
Because I experienced that.
So this is what you just said, Maria. This what you just said is exactly what it is. So if you have grown up to 65, 70, or in fact, sometimes due to your medical condition, they will just see your profile and begin to call you. When they call you, may saying hi, may agreeing to the talk you may not even know when introducing yourself to them or them introducing themselves to them. You say you do an affirmation like yes, all right, okay. You have signed yourself in.
Wow.
Yeah, that's how it is. So when you assign if you have this license, you assign yourself in, you become what we call a captive agent.
Oh my.
And if you become a captive agent, you cannot work for Trans-America and be working for national insurance company. If it is national, you are with national. You cannot work with any other company. And when they sign you in, they give you any number of years. They say that's what you agreed.
Jesus Christ.
Yes.
Oh, Lordy.
Yes. So if they sign you in, you become a captive agent, which means you don't have when you are speaking to customer or to somebody, you don't have an alternative. You only you'll be only you'll be selling one product. Yeah, you'll be selling one product.
Wow.
You don't sell more than one product. Now
That's really captive for real.
yeah, you
Yes, it is.
you become a captive agent. Now, if you do not enter a captive agent, you are an independent agent. Independent agent means that you can work for more than 100 companies if you like. For instance, through WFG, you can access more than 100 insurance companies, which means you can do business with this one, you can do business with the other one. You have a variety of choice to make. Your choice now will be based the one that you think that gives you what you want. So, but if you're a captive agent, you don't have that choice. So when you pass the exam, there's so many ways we try to restrict that, but however, everybody somehow have to restrict yourself. Definitely, if you pass, they give you a license number, your license has become a national. They give you what we
So
call.
if they call you, what do you do? Hang
If they
the
call
phone and
you, if they want to talk, they say you're not interested. Period. Don't call me again. You're not interested. Period.
sometimes they said, is this if I say yes, that is it. They say you said yes to their product or something like that.
Yeah, if they say if they call you, you hear it. What you do is, oh, I'm not
Okay.
interested on that. I have a company I'm working for. I'm not interested.
Oh
Sometimes, if you don't even know them, you just ignore them. If they introduce themselves, finish, because you have to ask, who is this? When you answer call, you have to say, who is this? They have to introduce themselves, finish. Oh, you say, please, I'm not interested. Bye.
Some of them can be very aggressive, even though they are begging for your this thing.
They will come with a sweet voice.
Oh my.
So, as it is a captive agent, so as is a captive insurer. An insurance established and owned by a parent firm or group of firms to insure the parent's loss exposure is referred to as a captive insurer. This insurer is opened up. They have a parent insurance group or parent group. They are captive. A risk retention group can be established as a type of captive insurance company. So we always try to let agents understand. Anyway, the person who brought you to the business will tell you what to do when you reach that stage. Yeah, we are trying to, but believe me, a lot of people has unknowingly entered. And it wouldn't some of them they say you sign a contract of 2 years, 3 years.
Hey.
It happened to one lady. The lady said, look at me suffering. I'm writing an exam. We have to talk. So there's some other ways you can come out, but it's become difficult until they have worked with them for some time.
Hey.
Yeah. That's a medical for you. So risk retention group. In risk retention group, we have what we call RG. Right, it's 8:30, we soon stop. We have what we call RRG and LRRA. I want to know the one that normally comes in the exam. I think RRG. All right, a risk retention group, RRG, is specialized insurance company created under a Federal Liability Risk Retention Act of 1986. I don't ask these questions. There's no need. We have not seen it before in any question. Risk purchasing group, because every insurance is about risk. They purchase the risk for you. You pay them premium. That's what insurance is all about. Reinsurer, yeah. Reinsurer is one of the things you may see in exam hall. Reinsurer are a specialized branch of the insurance industry because they insure other insurers. How does reinsurers come? Some insurance company may not be able to pay a particular risk. They will draw in another insurance company to help them in what? Covering the risk. You know, some risks have some rated risk, which is substandard risk, that are too big that they cannot be able to cover the amount. Insurance company put heads together and be able to insure the policy. That's what they do. That's what we call reinsurer. Reinsurance is an arrangement by which an insurance company transfer a portion of the assumed risk to another insurer. Reinsurer typically occurs to limit the loss that any single insurance would face if a significant claim becomes payable. So, because of reinsurer, the insurance company will now gather together, 4 or 5 insurance companies gather together. They have to divide the policy, divide the risk by themselves. How do they divide the risk? They divide the premium. The percentage of premium you get based on percentage of claim you are going to contribute to pay the claim if the loss occurs. So that is reinsurer. Reinsurance, one company decides to, one company get a somebody want to insure, and that person have a high risk, and that high risk we attract big claim. And you know what attract big claim means that the premium will be so big. So just like plane, some airlines. Do you think it's one insurance company that's covering airlines? No. No. It's the reinsurers. Most insurance companies come together to cover airline. If not so, if they have air crash, you know how many millions they pay? Yeah. So, but most insurance companies come together to cover an airline. So if there's any crash, they pay huge money for the plane that crashed, for the individual inside the plane. They pay huge money, big money. So they pool resources together to cover the airline. When there is any claim, of course, they pool resources together to pay the claim. That is reinsurance. So in a reinsurance agreement, the insurance company that transfer its loss exposure risk to another insurer is called the primary insurer or ceding insurer. So remember, it's a job. One insurance company first get the job. Now he call other insurance company. So the one that first get the job is called the primary insurer or ceding company. So the one that he calls, either one or two of them that he calls to come and help are called the reinsurers and also called the assuming company. The assuming company. The ceding company is the primary insurer, which is the person that first get the job. Now, he cannot do the job, cover the person alone because the risk is massive. He brings 3, 4, 5 insurance companies. So those 3, 5 insurance companies brought in to help him is called reinsurers. And they are also called assuming company. Then the one that brings those 4, 5 insurance to help him is called the primary insurer or ceding company. So that's reinsurer. I think that's the thing we need to know on reinsurer. The primary insurer, ceding company, and the assuming company or reinsurer. So remember, when they come together, they have to write an agreement, what we call the treaty insurance. That's a typical insurance contract between 2 insurance companies. So the company may be 4 or 5, but they're going to write a treaty, a contract that stands for them for that particular job, so that they can be able to cover that person. They write what we call a treaty insurer. It's a contract between all of them. That contract is what gives everybody power to do what he will do. The percentage you're going to cover and the percentage of claim you're going to bring if there's any loss occurs. Yes, that's what they do. So most of those big policies, you do not see, or it's not only one company that insure them. Yes, not only one company. They bring themselves together. So in some situation, a primary insurer will seek reinsurer tailored to cover a specific risk or exposure without an ongoing agreement. This type of reinsurer is referred to as facultative reinsurance. So when such, remember what we call treaty insurance, when such companies gather together to cover that particular risk, they have a contract which we call treaty insurance. So some of them, they will come together without any contract. Those ones are called facultative reinsurance.
Oh.
They don't have any contract. They will be the say what they say through using mouth. No contract, no binding contract. You are sure of what you are doing when there's a binding contract. But in this case, there's no binding contract. When there's no contract between those companies, it's called what? Facultative reinsurance. So I think probably we're going to stop here today. Exemptive, what you're going to know about this thing is about this reinsurer is insurance for insurance companies. Insurance for insurance companies, that is reinsurance. Treaty reinsurance is broader and automatic. Facultative reinsurance is tailored to specific risk on a case-by-case basis. There's no contract. The ceding original insurer remains responsible to the client. So the ceding company is responsible for the client, which means he is still responsible. He is the major shareholder because he brings the business before he brings others one. So every other contract is made with other company. You as the person that brings the business does not know them. Your contract with the primary insurer. So I think we'll stop here today, this night. Tomorrow we're going to start from surplus lines insurance, which is we are 4 point something. What are we? Something. All right, we are 31%. So we are going to start tomorrow morning with surplus lines insurance. That's where we start tomorrow. So this, this is the beginning of the whole thing. Don't miss it now. All right. So I think we're gonna stop here today. We have tried. Tomorrow morning we start from where we stopped. This is the basis, this is the starting of everything we are doing. This is started. So we're going to continue from there. This chapter we will treat it is a lot. We're gonna we're gonna do the types of insurance. Remember, we have done the types of insurance company. We're gonna see in this chapter do types of insurance. So we have talked about the two types of insurance company, which you talk about the mutual and the stock company. We say the mutual company says participating policy, while the stock company says non-participating policy. We went ahead to talk about mutualization and demutualization. We say mutualization is when you are converting mutual company. When you're converting the stock company to mutual company, it's called mutualization. When you're converting mutual company to stock company, it's called what? Demutualization. So, and mutual company says participating, stock company says non-participating. So I think we're going to see tomorrow, we're going to start with surplus lines insurance. Remember, multi-line and monoline. Multi-line insurance company is a company that deals with a lot of different types of insurance, while monoline deal with only one type of insurance. So, all right. So see you guys tomorrow. Good night, everybody.
Good night, sir.
Yeah, good night.
Thank you. And then we can.
You're welcome. Yeah.
Thank you, Professor. Thank you.
Thank you.